as we mentioned earlier, markets are measured in sessions, in time. We measure price and time in markets based on the open, high, the low, and the closing price. So during a session, there'll be a price that opens up for this particular, we call them instruments, meaning either a share or a bond or a commodity or a currency. The opening of the session, this is the price that this particular whatever opens at. We'll just say a widget. Now, there'll be during this session a period of time that the highest price that is reached. We'll keep track of that. And there'll also be a price where it reached its lowest point. And then there's a final closing price that has happened. Now, how do we measure this? Well, we measure this with a variety of ways. One way is with bars. Let me explain. Let's take a look at this candle, this bar as it's called. When you have a bar, we are measuring the opening price with this little notch on the side. The open will always come into the bar from this direction, signifying that it's the opening. Here's the little notch. And then we will next measure the high. The high is the point at which the top of the bar reaches here. There are no notches there. It's just that point is the high. Then the point at the bottom is the low of that bar. And then as the market exits or ends going this way, because time moves from left to right, this will be the price. This little notch is telling you the price that the market closed. And when you have the open price higher than the closing price, meaning that price has fallen from the open to the close, this is called bearish. The price closed lower than it opened. Conversely, bullishness is when the price closes higher than the open. And a bullish bar will look like this, where the opening price comes in here, the high reaches up here, the low reaches down here, and it closes, leaving the session at this price. That is bullishness, when the price closes higher than the open. Now, next, we have the candle. Now, the candle is much more expressive and easy to read for many traders, and you'll see why in a moment. It does the exact same thing that a bar does, but it's a little bit more visually appealing. You'll see in a moment what I mean. They're called candles because they seem to have the look of a candle with a wick, also known as a shadow. This would be a bull candle, meaning that the price has gone higher from the open to the close. The bull candle is the candle that's either clear or open like this, or it may be green in color. And a bear candle would be black or filled in or red in color. Now, this is how they measure with a bull or bear candle, with candles. First of all, we have names. This is the body, and these are the shadows. Within the body, you have to be very careful. Once you understand it, it's extremely simple. The opening price of a bearish candle would be at the top, and the closing price would be at the bottom, with the high and the lows on either end. Now, with a bullish candle, as we've seen here, This bullish candle is saying that the open is at the bottom and the close was at the top because the price closed higher than the open. And we know to measure from bottom to top because the candle is open faced or green. And with the bearish candle, we know to measure open to close from top to bottom because it's either black or red, filled in or red. And again, the highs and the lows are always on the outer edges. Now, this gives us a little bit more of an edge visually when we're looking at a chart. At first, you might think that the bar chart is easier, but when you put this all together in a chart and not just the individual candle or bar, you'll see that visually you get a better picture of what's happening with the price. Let me show you. Here we see the candle chart going across one after the other. Each candle represents a time period. We'll say a day. It could represent 5 minutes each candle, or it could represent a whole week of time. So if it's a candle that's representing a week, that would mean that each candle is saying during this time period of one whole week, the open, the close, and the high and the low was in between this area of price. But let's go back and we'll just look at it as a day, because there are time periods that we can, all different types of time periods that we use in market analysis for different reasons. But we'll just say that this is a day. It really doesn't matter right now. Looking at this, you see time moves across this direction and price moves up and down vertically. So as we can see the price moving down, notice that we're seeing a lot of black bars. Okay, you can just look and see the black bars, and you can see when it's correcting, as we call it, when it comes back up, because the market never moves in a straight line. It will always have some type of zigzagging motion. But now notice in this up movement that we see more white bars than black bars. Visually, it's just quick to see. Now, compare that with a bar chart. Notice that in this bar chart, you don't see visually the black or the white or the red against the green as the price moves down. You just simply see the price moving down, but which candles were the up days and the down days? It's harder to tell. You have to look much closer, and you can't see it from a broad view perspective from the whole trend here, okay? You have to go each candle and look, well, this was here, down there, now here. It just doesn't have the same visual effect. Okay. Remembering, just in retrospect, that the main thing to remember is that price works its way across in time, and its value goes up or down. Very simple. And that's basically how we measure price and time in a price chart. What we're going to do next is we're going to look at market analysis. And what is it exactly?